Welcome to another episode of Visions and Voices, where we delve into the intricate and dynamic world of family offices. I am your host, Chris Mays, a partner at Armanino, one of the top 25 consulting and accounting firms. Here at Armanino, I have the privilege of leading our family office industry, helping ultra high net worth individuals and families navigate the complexities of wealth management, tax planning, and legacy preservation. In each episode of Visions and Voices, we bring you insights and expertise from leading professionals across various fields relevant to family offices, from legal experts and investment strategists to technology innovators and philanthropy advisors. Our goal is to provide you with the knowledge and tools to manage and grow your family's wealth effectively. Today, we have a special guest, Sharvil Sheth. If I'm getting that right, Sharvil, is that how you... Okay.
That's correct. Yeah.
Sharvil brings 15 years of multi-state tax expertise, including income tax, franchise, property, and sales tax. He negotiates and secures various U.S. federal, state, and local tax credits and economic incentives. He's served as an expert to companies in multiple industries, including manufacturing, warehousing, distribution, aerospace, data centers, telecommunication, technology, and fintech. Over his career, he has helped clients secure over $500 million in savings through statutory credits and discretionary incentives for income sales tax and payroll taxes through cash grants or utility savings. Sharvil, welcome to Vision and Voices. How are you?
Great. Thanks for the introduction, Chris. Happy to be here. And as you mentioned, yeah, in my role with the firm, I lead the credits and incentives practice. So I'm based in Chicago. I'm the Tax Now group, and I work with a number of across varying industries on a number of different matters. But I think ultimately, what I'm trying to do is drive the most value for any project that a company's doing to kind of maximize ROI.
So tell us a bit about your background and how you became an expert in tax credits and incentives.
Yeah, so traditional, accounting background. I went to college here in Chicago at DePaul, accounting and finance, and out of college, worked at a couple of public accounting firms, in Big Four and Top Five, and then I had an opportunity to go to my last firm at PwC. Previously, I was focusing mostly on the state and local compliance side, and this was more of a consulting role to focus on credits and incentives. So it's kind of was intriguing, when you're on the compliance side, you're always giving bad news. Oh, you did this wrong, you did this wrong. When you're on the C&I side, I'm like, oh, I got an opportunity to get you $10 million. Would you be interested in listening to us and doing a project? So it was nice to be like, oh yeah, sure.
Yeah, that's a much more fun conversation.
Yeah, it's always a much more fun conversation. So that's what I was doing until I joined the firm for an opportunity to kind of start a C&I practice. And when I say C&I, it means credits and incentives from scratch. So I always found that part really appealing. And I think the main thing with respect to credits or incentives is you get a little bit of enthusiasm, and it's kind of a tip of the spear for other services where you found a credit or incentive. It can fund your other kind of tax projects as well. So it's a little bit more of what I like to do. Part of what what C&I involves is negotiation with local jurisdictions. Kind of, you're seeing an impact of a company coming in, adding investment jobs, and just kind of revitalizing communities that have been kind of impacted for whatever number of reasons, whether it's economic or COVID or whatever. So it's been great to see kind of, trying to make a difference to that sense as well.
So give us a brief overview of the most significant tax credits and incentives available to wealthy people. I mean, you talked a little bit about revitalization, and I know opportunity zones were big, but what opportunities, what other, and how are those organized? I mean, there's federal, state, like what give us the landscape.
Yeah, right now I think the hot topic, as it's been since 2022, has been the Inflation Reduction Act. And what that does is it provides, it revamped a lot of the existing programs that have been in place for kind of these sustainable investments, but it's changed them in a way where you're able to monetize these benefits. Before it was just a non-refundable tax credit, which was maybe, some percentage. Now these percentages have been juiced up so much that, for an example, if a wealthy individual is going to put in a solar panel or do a solar panel project, they can almost get a 50% offset on the cost and then also utilize that credit upfront, which is pretty impactful. And the other thing is there's a lot of mechanisms to kind of monetize these credits that weren't available before, where you can also sell them for cents on the dollar, 90 cents. So it is important, not just for high net worth individuals, but let's say you're a heavy manufacturer, you've got NOLs, you've got depreciation, whatever. You operate a tax loss, so you don't really have a reason to do a project to kind of generate credits because you're not going to be able to ever use them. Now you can sell them or
to get the benefit of that.
Exactly. And the cash doesn't recognize as income either.
So wealthy individuals can buy those tax credits for a discount and then get the after-tax return.
Yeah, exactly. And there's two ways. We are seeing a bit of activity where high net worth individuals are entering into, for example, I'm going to stick with the solar example, projects where they're putting those in place. They're getting the tax credit benefits that I've mentioned. You also get depreciation, and then they're also able to further monetize a project because they're able to sell the excess power that's been generated to a utility company. So they're producing income that way too. So, $1 million investment can net you $500,000 of credit on top of depreciation, and then also ancillary, other income that comes from a utility company. When you kind of add that all together, it's not a bad way to kind of, if you're thinking about it, making an investment to kind of, it's not a bad time to kind of think about that.
Yeah. So I mean, it provides a number of different benefits, right? I mean, it de-risks the project for you to the extent you're taking on project risk, in that if you have other taxable income, you're getting the benefit of that tax credit. And then you also get the benefit of the depreciation, because it doesn't have to be specific. The tax credit is fungible. It can be used against any income tax, correct? I mean, it doesn't have to be the income generated from the specific project, does it?
Yeah, right, correct.
Okay. And the depreciation, I guess that isn't perfectly fungible unless it's in a collection of projects held by the same.
Right. Exactly. And then there's a couple nuances there. You adjust the basis for the amount of credit, things like that. But yeah, you're able to get kind of.
So you don't get to double dip.
No.
The tax credit that resets your basis, right? So
yeah, if you have a $1 million investment, and then you get a 30% credit on that, your basis is $850,000. You kind of take out the credit amount and you back it out. So
okay,
yeah.
But in these solar projects, are these single family residence rooftop projects, or are these utility scale?
It depends. Where we're seeing these projects have been done on a really large scale. Banks, Goldman, Wells Fargo, where there's hundreds of millions of dollars of investment. And then you saw the residential. What's appearing now is this middle market where you're not doing 10,000 panels across, but maybe 5 to 500, and either it's industrial, so a bit office park, or a bunch of residential. And now it's more economically feasible because of these credits and the way the ROI is generated on an investment, that this middle area, and which is, I think, would be most applicable to our clients. So when they're considering this, or if this is even something, I think the way we can help is we can evaluate a couple of things just to make sure they're maximizing the benefit. A lot of these projects, the programs have what's called prevailing wage requirement. So you got to use union labor. We're gonna make sure, so that's one. Two, there's a added bonus for a domestic content certification. So if substantially all of your products are manufactured in the U.S. that comprise of the solar panel, you'll be able to get a 10% bonus. And three, I think we've got
You
access.
can't use Chinese solar panels.
Right.
Almost all solar panels are made in China.
Well, there's a formula that from now until I think 2027, that substantially a portion of, there's a percentage that you have to hit, that of that percentage, it meets this what's called domestic content requirement. So right now it's 40% of your project has to hit that, and it goes up to 55% through 2026. And there's a formula where you take all your products and then the products that are kind of in the US without, and then you'll get some sort of percentage off that. And the IRS is continuing to issue guidance on this to kind of ways to simplify it. Because obviously when initial regulations dropped in 22 is pretty convoluted, and there's been comment periods. So that's another way we're helping clients. And two, and I think the last thing is, if you're in an energy community, so Pennsylvania historically, or if you go in certain areas, you get a 10% bonus on top of that you're putting renewable resources in that community. We've got access to the DOE databases, kind of can help you look through that. So just all other things being equal, if you go across the street versus stay here, can you get 10% more in your credit? We can kind of help with that. And then obviously we've got our broader tax team to kind of help with kind of the planning and as well.
So there are like project level decisions that, so whether you're on one street or the other,
potentially. Usually the way it works out is they've got kind of, let's say a long list of locations they're thinking about. Maybe up to 20. Say we can look at all of them and kind of confirm this one's in a zone, this one's not, and then that can help kind of refine their decision.
Give a
short list. Yeah, and then everything else.
How you assess which are the best site for the project. Okay.
Yeah, and we do that for kind of, if it's a corporation or family. The process for us is pretty much the same. It's a phased approach. Phase one, I'll get information on a project, and then, based on kind of the research we've done, we've got almost every state deep contacts, because we've done projects. We can kind of level set on a no-name basis, kind of what may be available. And at the end of that, we'll put a summary together with a range of benefits, saying, if you go here, this is kind of the range, the world of the possible. And then phase two, we talk through like with our client, hey, maybe we go for the $1 million grant and then not put the effort in to go for the $25,000 training credit or whatever, right? And then we focus on the most optimal value. And then three, some of these have a tail. Phase three, some of these have a tail where you have to do annual reports or compliance. We can help with that. So that's kind of how we approach these.
So I mean, solar is kind of I have gotten a couple requests on solar projects here recently from wealthy families. Is that the topic of the day in terms of tax credits? I mean, what about R&D tax credits or opportunity zones? I mean, we did a project in one of the opportunity zones recently for a client. It was a massive both state income tax and then the tax in this case were abated because the project was in the opportunity zone.
Yeah, that's kind of what I historically did, and it's my bread and butter. Where by way of being in a state specific zone, not the federal opportunity zone, but the state enterprise zone. If you're located there, it opens you up to a suite of programs that historically may not be there, and that depends state by state, right? But yeah, you hit it on the head. Generally, they require some sort of job creation at some sort of wage, but because you're going to an opportunity zone, it's more likely than not a very low severe census tract or a demographic where that threshold is not going to be $80,000 a year or something. It's going to be kind of the average county wage. You're kind of, to my earlier point, revitalizing that area And because of that, the community is going to say, because you're creating these jobs and investment, we're going to make this more palatable to you. So you're going to get an abatement on property taxes, any other cash grants, whatever. And those are above the line benefits. What we're talking about here for the federal credits is kind of, below the line unless you sell it. That is always going to be able to be monetized by a company because you're always going to have to pay property tax, payroll, sales tax as well.
Yeah. 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 Okay. So are there any strategies that incorporate tax credits with estate planning? Or, most of our all of our family office clients have taxable estates. Is there anything to do with tax credits and estate planning?
Yeah, it depends, but usually these credits do flow through up to the individual level. So depending on how the entity is structured, that the business, yeah, they could make their way up all the way to the individual level, shareholder level as well. So there would be a way, and obviously if they're paying taxes, yeah, there's a way to kind of offset their federal taxes. Unfortunately, these credits are going to be limited to that level. So if you're in California, you're still going to be subject to the state level taxes. Some of these states are starting to, what I would say is mimic IRA at the state level, where they're adding a state level solar credit or whatever as well. So maybe you can kind of bundle those up, or they may just have a traditional investment credit where investment over 500,000 is eligible for X percentage, as long as it's over a depreciable life of like 3 or 5 years, something like that. So you kind of stack those together as well to kind of try to maximize the benefit to an individual or an estate.
So what would you say are the most underutilized tax credits that wealthy families might be able to use?
Right now, it kind of depends on a facts and circumstance basis, but there are a number of federal credits out there under IRA chips that are just previously were not evaluated. So I would say from that standpoint, and then there's also, I think, state level impacts that.
Just explain a little bit further there. Under the Inflation Reduction Act, IRA, what are
yeah, so I mean, there's a whole host of programs that are out there. I'll just say, everyone knows if you buy a Tesla, you can get this credit or whatever.
Yeah.
But there's also a bolt-on credit for EVs, other types of renewable. You've got a biomass operation. One thing that's been overlooked that we've seen is kind of certain types of HVAC investments are also eligible. So it really depends on kind of your project. And what we can kind of help you do is, if you've got kind of a listing of investment, some of the more common items you think would not qualify or actually qualify because the regulations are somewhat broad in eligibility. So, I mean, obviously solar, wind, whatever, but there's other items in there that we can kind of help you qualify as well.
So if you have a family building a multi-family building or developing some, or some other commercial real estate project, or is that a good time to look at what?
Yeah. So I think that the best time for our team's involvement is before a decision is made, because at that time you lose your negotiating leverage with the jurisdiction, as well as kind of maybe you did not make the investment in a certain way. So you may lose some ability to qualify for the credit. So if there's a way before a decision is made, or if there's a short list of sites, let's say 3 to 5 locations under consideration, we can kind of put some thoughts together to help you maximize the benefits. Like, we fully understand C&I is not going to be the key driver, right? When you have a project, it's
Right.
Supply chain, whatever, employ it, but it can make a good deal great. So it's kind of like a cherry on top with some sprinkles on your sundae, where if all other things are equal and you can get these programs versus not, why don't we just go here, right?
Right. So you don't let the tail wag the dog.
That's exactly right. And then
like
upfront,
icing on the cake, if you can look, my project lines up on this. And by the way, so basically any wealthy family that's gauging on any project, whether it's real estate, new business, they I mean, is there a reason not to reach out to your team
No,
to?
absolutely. And we're happy to have an initial conversation just to kind of level set. If they're going in, I'll just use like Wyoming, for example. There's not going to be much from a CNI standpoint because the tax climate is already so competitive. So, it's not going to make a difference because if you go there, the cost to operate is going to be much lower. But if you're thinking about California and Arizona, that's where it would make sense to have a conversation and we can kind of outline pros and cons for both states. And from a purely credits and incentive standpoint, Arizona is going to blow your project out of the water because they're just going to be so much more competitive with the programs that they're offering. Yeah, but I think anytime a project's under consideration, happy to talk through or any considerations from this standpoint to kind of maximize as best as we can.
So, I mean, okay, so we've talked about the upside, but what are some of the downside? I mean, what are the like compliance issues?
Yeah. So there's the two things we mainly see is one is there's usually I'm well, mainly from the state level is that's where you negotiate most of these incentives. There's likely going to be a public meeting to have approval, and then some sort of release saying this company is expanding here and they're going to commit 25 jobs and 20 million of investment. So that's out in the public sphere. I've worked with a lot of Fortune 100 clients in the past where sometimes they didn't want that out there because as part of that release, they're going to say they negotiated some sort of packages or whatever. So that's one thing. And then two,
Public disclosure.
public disclosure, yeah.
You know,
And then you have to just make sure annually you're meeting those requirements. The thing we try to do is you mitigate clawback on incentives. So if let's say you only get to 20 jobs, you may have to
wait one sec, because so I guess that's a bigger deal because I remember when Caruso built the Miramar Hotel up in Santa Barbara, he negotiated, and I can't recall all the details, but he negotiated a very healthy property tax abatement, I believe it was, and got a fair amount of
yeah.
bad press related to that. Like, why does he need? He's a billionaire. Why does he need?
Yeah, and I think for a layman, it's hard to understand why a entity that or high net worth individual is getting these benefits that are public subsidies that could be going to whatever. But I think what they miss is that development is going to add more tax
Right.
to the rolls over this period of time. And what they get a benefit of is just the upside, not your base remains the same, and they're adding more to the rolls, and they're just getting a reduction. And then after
Hypothetically, right? If everything works out, that's
and then after the 5-10 years, there's just it's going to continue to rise. And then they're adding jobs, and I think jobs is the main differentiator. Once you add jobs, there's this concept of an economic multiplier where one manufacturing job adds like 8 downstream jobs. And I'm saying, a restaurant worker, gas station, whatever, it just kind of explodes,
yeah,
revitalizes a community, which is it's hard for kind of a non-practitioner to see that, but that's one thing that is to think about. And then just there's an annual, I mentioned, there's an annual tail to these. So you have to file these reports 5-10 years. You just got to make sure you're hitting your benchmarks. What we try to do is, let's say that example I gave, they're kind of sure they're going to hit 25 jobs. What we would do is we would make sure the agreement is negotiated in a way that we're just going to commit to 20, and just to make sure we take the risk of not hitting those requirements. So we'll help you kind of set you up in the best way possible, just to make sure you at least hit or exceed your.
Oh, so you guys do the administration of that annual benchmark process of ensuring that you met the benchmark reporting. Okay. Yeah. Okay. So the public disclosure, not getting the compliance portion of it done, right? This
Mhm.
benchmark reporting. Those are kind of the risk to these things. I guess like with some of the solar projects, there's been an element of the project risk too, right? For folks that are maybe passive investors in the solar tax credit, if the project doesn't actually get completed,
Right. Yeah.
and they're out the money and they didn't get the tax credit.
That's exactly right. And it's a bit of a new space. Saw a little bit more activity in 23. Right now, it's starting to ramp up. I think it's going to start getting fully materialized in the next couple of years. But yeah, that's right. I mean but that's just the normal investment risk for any
It's a
project.
new space. I mean, these solar tax credit deals have been going on for at least 15 years, as far as
Yeah,
I'm. But you're saying the IRA.
I I think it's on as I mentioned on a large scale. You had banks, everyone doing that because they could harvest the credits. But now this niche market, not niche, but this middle market here, from 50 to 5 to 50 to whatever, like a bank like Goldman Sachs would never do a project for that amount. But now if you have an individual who wants to put in 50 panels for whatever $1 million, or I think they can do that, and now they have these benefits where before the credit was it wasn't worth it based on the amount of credit that would be generated.
Oh, I see what you're saying. So now the credit is worth it
Yeah,
for these smaller, right? So manufacturing facility is going to put whatever 1,000 panels on their rooftop. A wealthy individual come in and finance that, get the tax
yeah,
credit. That
yeah, exactly.
instead of like Goldman Sachs having to aggregate up 50
Right,
million, 100
right.
million as a
It, that's
scale
exactly right.
project.
That's
Okay.
exactly right. So this middle market, and I'm calling it a middle market, but it can go, anywhere from 5 to 10 to, hundreds, that's the space that's kind of expanded because it was just large scale projects in these fields before, which is now kind of, we're seeing a more of a activity around, which I
And
think would fit with the family office profile.
yeah, so talk a little bit about the fungibility of, I mean, we talked about a little bit before, but like, let's say you don't have a project, but you got a pile of money and you want to get a return on that money, and you have other income, so you're constantly paying taxes. Like just investing as a passive investor to get the tax credit, what are the ramifications of doing something like that?
Yeah. So, let's say you've got $1 million of income or tax liability, federal tax liability annually. What these credits can do is that, let's say that's what your liability is for 2024. You place a project in service in 2024, that's the year you're going to generate the credit. So it's $1 million solar investment. Let's say you just get 30%. You have a $300,000 credit that you can use to offset your taxes. It's not limited to just business income. It can be off the way it flows through it at an individual level. It can kind of offset your combined liability as well, depending on kind of a couple other items. And the other thing is there's a carryback mechanism too. I haven't seen too many clients do that just because of the pain required to amend returns, but these can go back 3 years and forward 22. So eventually there's a way to kind of use all of the credits. Yeah.
Okay, so in other words, you have the tax credit, you don't have enough taxable income in the current year. You can either carry it back or carry it forward.
Yeah, or just sell it, but then that way when you sell, you're giving up a portion of the credit. Like if I had a credit, I don't have liability, you would like to purchase it, you'd buy it 80 cents on the dollar. You kind of lose that.
Yeah,
But
you're getting some discounted value.
yeah, but I get the cash up front. So
Right.
that's another.
Yeah. Okay, that makes sense. So are all of let me ask, what are the emerging trends in tax credits beyond, hey, solar? It's all IRA type of stuff right now. How is how's the landscape in terms of tax credits changed over the last 10 years?
Yeah, I think there's a lot of focus on industries now. So data centers continue to be a very hot industry and lots of activity around there. Number of states have implemented. There's not many federal programs, but there's a number of states that have implemented specific programs around a data center
Well, let's
development.
talk a little bit about that because that hits one of my favorite topics, which is artificial intelligence. And I yeah, I mean, there's to say there's been a little bit of activity would be one of the bigger understatements. You know, I mean, there's quite a bit of capital has been organized, and there's definitely all sorts of supply chain shortages, and not just in the equipment that go into these data centers, but everything surrounding the site, being able to get a power connection, cooling connections, all of the, like the most basic transformer to knock down the line voltage down to what we're seeing shortage and all that. So I mean, we know AI is fueling that demand, but I guess the states now are in competition for these data centers.
Yeah, because so it's funny. When I first started doing credits and incentives, you would see deals, we thought $100 million was a lot. Now, when you get into data center, it's $1 billion at a minimum, right? And nobody bats an eye anymore. So it's just the scale of these investments are so huge that they realize if we're going to land a project, we're going to get 200 jobs paying $150,000 a year on average. You'll have someone like a Microsoft build it, but then you'll get these other tenants there, right? Those are the folks that are going to be in the community. The considerations that they've put in place is certain states just have more competitive power rates. So I think from a cost perspective, if that's your only driver, that'll kind of take out a lot of states under consideration. But a lot of states have put into place programs that can give you a deduction or an exemption on certain types of equipment, which is, racking, whatever, where you could just get an upfront sales tax benefit. Texas has a program like that. Illinois, there's
so you avoid paying sales tax on.
And the key with that is your tenants can also avail themselves of the benefit. So I think that's impactful if you're trying to get somebody to locate in your facility. You can say any equipment you qualify as long as it's on this list, you won't pay sales tax on it. And that's a pretty lucrative benefit.
Well, on $1 billion worth of investment, I mean, that's a fairly significant number.
Right. And what I've also worked with companies you've mentioned, requires a lot of power. We have worked on deals where we can get a substation or whatever paid for by utility for a service contract over a number of years. And then they'll work out the repayment on that. And then we already touched about the property tax benefits, but Texas offers city, county, potentially school on $1 billion. They tax personally and real. That starts to add up quick on 5, 10, 20-year horizon, the amount of savings.
Yeah. Right. That's interesting. So I guess what states where are the most attractive incentives for data centers? Because I do have a number of clients that have invested in data centers.
Yeah, you would not. Texas, I've already mentioned. There's a specific county in Virginia, Loudoun County. I've done 2 to 3 separate data center projects there. The state incentive is a sales tax incentive, but for some reason, there's just a lot of activity in that county. I know Meta's there, so is and a couple of other there. Virginia has been a new riser. A lot of Illinois, for example, has implemented a data center program as well. And then you've got certain states like Iowa, which they don't have specific programs around a data center. You qualify for a general incentive package, but Iowa is one of the lowest utility rates in the nation. Yeah. So that's kind of their package, but you can kind of get their normal non-data center incentives. You can probably qualify. And then those are kind of some of the newer states, Southeast. There's also, we've talked about data centers from an AI perspective. There's the crypto space too. That's also being developed now. right now, the one thing with the crypto sphere is most states are pretty open for that. I have received some feedback informally that their view may change because of just how they're viewing crypto in general. But right now, I think there's no restrictions on that. But a development I'm curious about is in the future, if a state would take a hard line against, we don't want, this type of activity.
Yeah. Yeah. Well, I mean, if you look at both parties seem to be moderating their tone with respect to crypto. So we'll
Yeah,
maybe
more to come.
we'll see more, yeah, more welcoming types of behaviors when it comes to
Yeah, right.
crypto. But AI, I mean, nobody seems to be getting upset at the AI folks other than just the sheer amount of power that those facilities require. I mean, both
Yeah.
for the compute, but also the cooling of compute is massive as well. So you got waste heat that you're either throwing out into the environment at some scale,
That's exactly right. Yeah. And the other thing is these just require so many resources from a water standpoint. So yeah, that's just part of the consideration.
Are there international considerations? I mean, are there international tax credits that are of any interest? And we've talked exclusively about domestic tax credits.
Potentially, I do just focus on credits and incentives.
So what's the political climate right now for these types of tax policy? Do you see tax credits and incentives as likely to continue, and how would that impact?
Yeah. So the former president Trump, he put in TCJ to kind of his view was just let's just reduce the income tax rates and then got step back on some of these credits. Biden has put these in place, which the Inflation Reduction programs are going to be in place until 2033. It'll be hard to unwind a lot of that because companies have made decisions on projects based on those credits. So
Yeah.
either part of the aisle you're on, it's going to be tough to kind of unwind that. I think if if the current administration stays on, these credits will continue to go. We may see an uptick in income tax rates. So that'll be further incentive to kind of monetize these credits. Otherwise, if former President Trump is elected, we may see a continuation of TCJ, just kind of the current climate as well. I will say at a state level, it's not really as impactful which side of the aisle you're on. More likely than not, though, the red states have more a tendency to have a balanced budget. So they offer you more cash above the line benefits, where blue states will offer you credits that are only offset against income taxes. Obviously, there's exceptions, but that's just kind of how it works. And then depending on the region of the country, manufacturers, a lot of them are in the Southeast region, and tech is obviously in West. So it kind of just depends.
So what's been the most rewarding aspect of your work in helping taxpayers optimize their tax credits incentives?
Yeah, I think we get in within an organization, and I'll start with a tax contact, and then I will talk to almost every stakeholder from C-suite all the way to an operations manager, and just understand how the business truly works. And then also further kind of their connection with the local community when we do a deal. So at the end of a deal, we want to make sure it's equitable for everybody. Understand, you got a local jurisdiction that's going to give up some revenue. You got a company that's going to be potentially putting a project in. We want to make sure it's fair. So being an intermediary to kind of get that connection, get a win for everybody is, I think, the most, that's how we're trying to win-win for everybody is, that's kind of the most rewarding part of kind of what we're trying to do here.
And so what advice would you give family offices just starting to explore tax credits and incentives as part of their financial strategy?
Yeah, I think the sooner the better in terms of before a decision is made. If you've got kind of considerations. Maybe just have a high level conversation. We can kind of help potentially guide the decision point. And then if there's specific questions, happy to talk about that. But, after a investment or decision is made, you may lose kind of your ability to go back and capture some of the savings. So
yeah, and so right, so because a lot of these are negotiated deals.
yeah, exactly. Yeah. I just, if you go to a car dealership and just say, I want to buy this, they're not going to give you the best offer. It's kind of the same song and dance with the local jurisdiction as well, or a state or even federal government.
And because you guys do this, know approximately what the states or what the jurisdictions have been willing to.
Yeah, we have a process where we'll research based on what you give us. We can benchmark based on just some data we have, and then we will have a no-name conversation where I'll say, hey, I've got a that's considering this project anywhere in the state, this many jobs, investment, what might be available, and start the conversation. And then if that state is selected, we can kind of get in an NDA, talk more in detail on kind of what may be available, file applications, things like that, disclose the name.
So how can our listeners learn more about tax credits and incentives and potentially get in touch with you for further consultation?
Yeah, I think if you have a company that is capital intensive and looking to this year-over-year recurring investments, that might be a good time to have a conversation. If you're aware of an event like a consolidation or opening of a new facility, that's a great time to talk through, because that'll be the perfect time to kind of tie in with a good story and a narrative. Job creation is a very key driver as well. And then if you just have any questions about federal state programs, happy to kind of evaluate those on a case-by-case basis as well.
Awesome. Sharvil, super fun to have this conversation with you and learn about tax credits and incentives. Thank you very much.
Absolutely. Thank you.